Mutual fund sahi hai, but which one? There are literally thousands of schemes in the market. So where should you invest? And you can't invest in just one mutual fund. You have to build a portfolio. So how do you do that? By the end of this video, you will have the complete knowledge to know which fund is better and where should you invest and how to build a great mutual fund portfolio. So please watch it till the end. This is part 2 of day 3 of Investing 101 series. If you haven't watched the part 1 of this video, I would highly recommend to watch that first, because in that video we extensively covered what are mutual funds, what are the different types of mutual funds ranging from index fund to actively managed funds to debt funds and stuff like that. And the last part is the risks and benefits of mutual funds. It is extremely important to first have confidence in the asset you are investing in. Only then you'll make a lot of money. For example, if you let's say have a lot of money but you don't have confidence in mutual funds, you'll keep investing less money. For example, let's just 3,000, 4,000 a month. In that case, even if you get 50% return, it is not enough. You have just earned 2,000 rupees. So first build confidence and then invest more money so that you grow more money, right? So please watch part 1 of this video where we covered all those things. In this video, we will cover how to pick the perfect mutual fund for you and how to build a great mutual fund portfolio. Plus, I'll show you live how to invest in a mutual fund. I'll use 2 platforms, Coin and Grow. And I'll also share my recommendation, the fund I have loved the most over these years. And being an engineer myself, it is kind of related to tech. So stay tuned for that as well. I'll reveal that in the end. So let's start. I'll give you a 6-step framework. Apply this framework every single time you want to buy a mutual fund or you want to build a mutual fund portfolio. And I think after this, you'll have extreme level confidence in what you're investing in. You would never have to ask anyone to review your portfolio. Let's start with the first part of this framework, which is goal definition. Extremely important, literally extremely important, because if you don't know yourself, the objective with which you're investing, then you would not even know when to book profits, when to invest more, when to do lump sum, when to do SIP. So this is extremely important. To define this, you have to ask 4 questions to yourself. First question, are you investing for capital appreciation or capital preservation? This is extremely important to answer because your mindset changes. For example, if you have 10 crores or 100 crores in your account, would you be investing for aggressive growth? I doubt. You would rather be investing for capital preservation because you have a lot of money, right? So you want to preserve your wealth. You don't want to take crazy amount of risk. But if you have no money in your account, let's say you just started your job, that is the time you should aggressively invest for growth. So perspective changes and your portfolio would completely change based on this. So it's extremely important to understand with the intention you're investing in. Okay. Second question, are you investing for long term or short term? When you invest in mutual funds, long term means anything greater than 5 years and short term means anything or less than or equal to 5 years. So define accordingly. And this is also very important. When you're young, let's say just 25, you might be investing for a really long term. But if you're let's say 55, 60, then you probably would be investing for a short term, maybe for long term, but define accordingly. Are you investing for long term or short term? This will change your portfolio because it's extremely important to understand your own perspective, the time horizon for which you're investing, and only then we can design the portfolio. Third question, are you investing for tax saving or just growth? This will also change a lot of things. Under section 80C of Income Tax Department, you can save tax on 1.5 lakh rupees if you invest in tax saving or ELSS mutual funds. So if you have that perspective again, this will change your portfolio. So you should have an answer to this question as well. Fourth, extremely important question, how much risk can you take? When I say risk, it's not as if you lose the entire money. It is majorly the volatility. If the mutual fund, let's say, performs 10% this year, next year minus 20, then plus 30, can you handle that? Or are you a kind of person who would want stable returns? You can't take this plus 10, minus 10, plus 20, minus 20. You can't take this volatility. So answer this as well. Now, to make it even more clearer, I'll take 2 examples. And I think that will just completely clarify you how to build a great portfolio. Let's start with the first example. So we have this imaginary guy, Mr. Sahil, who is just 25 years old and he has started his first job. I'll try to answer all these 4 questions for him. First question, is he investing for capital appreciation or preservation? He is investing for capital appreciation. He is aggressively chasing growth because he has just started his job. He is just 25 years old and he can take this risk and he wants to grow more money. Okay. So in that case, his answer is he wants to invest for capital appreciation, not preservation. Second thing, is he investing for long term or short term? He is investing for long term. He is just 25, so he's probably investing for 5 years, 10 years or 15 years. Okay, that's the second answer. Third thing, is he investing for tax savings? Yes. He gets salary from his employer and he wants to save tax on this 1.5 lakh under section 80C. So yes, he is investing for tax saving as well. Fourth question, how much risk can he take? He can take a lot of risk. He, at his age right now, in his situation, the situation he is in right now, he wants to have high risk, high reward. He can take more risk, he can handle the volatility, so he wants to have a high reward and high risk. Now, based on his answers, here is how I will design his portfolio. Since he wants to save tax, the first thing would be investing in ELSS funds. Let's assume his PF is 3,000. So 30,000, kind of 36,000 is gone under section 80C. So 1.2 lakhs is left. So we will invest 10,000 per month in an ELSS fund. Okay, so which is 1.2 lakhs over 12 months. That is gone. So out of 30,000, 10,000 is gone for ELSS fund. We are left with 20,000. Now, since he's young and he wants to take more risk and grow more money, we will invest the next 10,000 in a small cap fund. When I say small cap, I am basically talking about small cap 250 index fund. I am specifically saying an index fund because small cap companies are a bit risky at times. So I don't want the portfolio manager to actively pick companies. I would rather want to stick with an index. Small cap 250 is a group of 250 small cap companies. Okay, so we will invest 10,000 in small cap 250 index fund. Since it is an index fund, the expense ratio would be really less. So you will grow more money. Now we have invested 20,000 out of 30,000. We are left with 10,000. I will divide this 10,000 into two buckets again. I will take one mid cap because that will give us medium risk and medium growth. And in mid cap, I am not saying an index fund. Mid cap companies usually can shine, and a lot of mid cap companies can actually suddenly become a large cap if the company is really well, the management is amazing, and a lot of other factors. So I would rather want the portfolio manager, and portfolio managers are really smart people. They work for this 24/7, right? They're really updated with the market. So I would rather want the portfolio manager to pick these amazing companies in the mid cap segment. So this time I would not go with an index fund. I would rather go with an actively managed fund. So the portfolio manager would have the chance to pick great companies and hence grow more money. The return would be way higher than that. Expense ratio would be a bit more, but that's okay because I'm getting more return. Okay, 25,000 is invested. Left with 5,000. Now we have invested all this money in India. What if the Indian economy does not work really well? In that case, we will invest this remaining 5,000 in international fund. Here I would recommend NASDAQ. NASDAQ is an index in US. Just like you have Nifty here, imagine NASDAQ is an index in US. It is one of the index, and this index majorly focuses on tech. It has a really high weightage on tech. I think tech is amazing in US. You have Amazon, Google, Facebook, Apple, all these amazing companies in US. So this one would aggressively invest more in tech. 5,000 in that fund. Now we have successfully invested 30,000 in these amazing funds, and we have built a great portfolio because this portfolio takes into consideration the growth we want. At the same time, the risk has been mitigated. We have even taken into consideration that if Indian economy does not perform really well, even then our portfolio would not suffer. So this is an amazing portfolio. Now this is from the perspective of Mr. Sahil, who is just 25 years old and has just got his first job. Let's take the second example, which is, let's say, Mr. Ram, who is 50 years old. So he has worked all his life, saved a lot of money, and now he wants to invest in mutual funds. Now let's see what's his perspective. I'll try to answer these four questions again. Is he investing for capital appreciation or capital preservation? He is investing for capital preservation. He has earned a lot of money in the last 20-25 years and he does not want to take crazy amount of risk. He wants to preserve his wealth. In that case, his answer is capital preservation. Second question, is he investing for long term or short term? In his case, let's say he is investing for long terms, greater than 5 years, but because of sudden health issues or let's say child education or a couple of other reasons, he might need some money in like 1 or 2 years. He might need it, he might not, he might. So we'll have to factor in that as well. Third question, is he investing for tax savings? No. Let's say he is not even getting his salary now. He is not investing for tax savings. So his answer is no in that case. Fourth question, how much risk can he take? Here, since he's 50 years old, he has a lot of responsibilities. Let's assume he can't take a lot of risk and he can't even take this volatility. He doesn't want his fund to perform like 10% in 1 year and minus 20 next year. He doesn't want that. He wants a stable mutual fund. Average return, but average risk. He doesn't want to take a lot of risk. Okay. Now, here is how I will design his portfolio based on his answers. So let's take he wants to invest 25,000 per month. I'll invest the first 5,000 in an index fund, which is Nifty 50. Nifty 50 is an Indian index. It is a group of top 50 companies of India. So extremely safe. So he is definitely not losing money unless the whole economy collapse, which is, I don't think is gonna happen. I'm pretty bullish on India, to be honest. So basically this is pretty safe. At the same time, he'll get growth as well. So now the first 5,000 will go in an index fund, which is Nifty. Again, it's an index fund, so the expense ratio would be really low. So more profits basically, 5,000 invested. The second 5,000 I will invest in Nasdaq. As I mentioned in example 1, Nasdaq is an index in US, which is kind of tech heavy, and I'm really bullish on tech and also pretty stable, pretty safe as well. So 5,000 would be invested in Nasdaq. So our risk is also mitigated, where if Indian economy does not perform really well, even then we are safe. 5,000 in Nifty, 5,000 in Nasdaq. Now 10,000 is invested. Now I've mentioned that although he's investing for more than 5 years, but he might need money in less time frame. Let's say he might need money in 1 or 2 years because of some sudden expenses. In that case, I would not even invest the complete amount in these equity mutual funds. I would invest 10,000 in a liquid fund. A liquid fund is basically a fund which is kind of debt fund. It is very stable. You would not get crazy amount of return, but there is almost very little risk. And he can literally withdraw money whenever he wants without even a loss, to be honest. So I will invest this 10,000 in a liquid fund. 10,000 we have invested in Nifty and Nasdaq. 10,000 will go in a liquid fund. This money can be withdrawn whenever he wants. So we are safe from that angle as well. Remaining 5,000 I will invest in a hybrid fund. A hybrid fund would be that invests in both debt and equity. So we will invest 5,000 in a hybrid fund. And in this way, I will design his portfolio, which is 25,000. And considering his answers, which is low risk, average return, capital preservation, and no tax saving, and more than 5 years of investment, but may need money earlier. And I think these two examples would have given you a good idea about how you should design your portfolio yourself. You might be in some other situation. The examples I took might not exactly replicate your life or situation, but I think you would have got a fair idea about how to think about it, how to design a great portfolio. Okay? That was point 1, defining the objective or the goal. Now let's move on to second point. Now the second point is performance. Whenever you invest in any mutual fund, you should always check the historical performance. Now I'm not saying that the historical performance that you see, it would exactly be the same in the future, but even then you should at least look at how the fund manager has managed his fund when there was economic uncertainty, when let's say the economy was not performing really well, when Nifty was at its peak, when it was at its bottom. Should look at all those factors and see how the fund has performed during that time. This will give you more confidence when you invest in that mutual fund. Now, very, very important point. When you look at the performance, please don't look at the 1 year performance. Never ever look at 1 year performance. It will not give you any idea about the mutual fund. When you invest in mutual fund, you should always look at 3 year, 5 year or 10 year performance of that mutual fund. Don't ever look at the 1 year performance. Okay. To see that, I will now log into Grow and I'll show you how to exactly look at the performance. So here is Grow. You'll go to Explore, then you'll go to Mutual Funds, and let's say we want to see mid-cap mutual funds. Now I've got a list of mid-cap mutual funds. For example, let's say Quant Mid-Cap Fund Direct Growth. So the very first fund I see here is Quant Mid-Cap Fund Direct Growth. 1 year performance is 73.2%. Completely ignore it. Don't even look at 1 year performance ever. We'll move to the second column, which is 3 year. In 3 years, it has performed 38.7%. This is just crazy. To be honest, Quant mutual funds have been performing really well. Homework for you, check out all the mutual funds by Quant and compare it with the peers. You'll see crazy amount of returns by Quant. So maybe we can invest a bit more money in Quant. Third is 5 year, which is 32.9%, which is again crazy, amazing. This fund has given you 32.9% year on year the last 5 years, which is just amazing, to be honest. So this is how you would look at the performance. 3 year, 5 year. A fund might be new, which basically means it might not have 10-year data, but if you do have a 10-year data, which is pretty nice, which is pretty amazing, you should look at 10-year data as well, which will give you much more confidence when you start investing in a mutual fund. So I think this is how you should check the performance of a mutual fund, but it is not yet complete. We have just got like 50% of the data that we want. Now, extremely important point is point number 3, which is expense ratio. Now, I'm not sure how clear you are with expense ratio. A lot of people think this is the percentage from the profit that is deducted, but that is not true. Expense ratio is charged on the investment that you do. I'll take an example to make it extremely clear for you. For example, you invest 10,000 rupees in a year and the expense ratio for that mutual fund is 1%. And the return from that mutual fund is also 10%. Now, when I said 1% expense ratio, this will be charged on your investment, which is 10,000 rupees, which basically means 1% of 10,000, which is 100 rupees. So this 100 rupees will be deducted from your investment, which is 10,000. So now you're left with 9,900, and this 10% return you will get on this 9,900, which basically means 990 rupees. So you got a return of 990 rupees. Now you invested 10,000. Your return was 990 rupees, the profit that you made, but 100 rupees would be charged by the AMC for managing this and for actually investing on your behalf. So now 10,000 plus 990 minus 100, which is the AMC commission expense ratio. You're left with 10,890. Now look at this. Had the expense ratio been 0, you would have grown 1,000 rupees. Your 10,000 would have grown to 11,000. But since the expense ratio is 1%, now you have gained 890 rupees. So your 10,000 rupees have grown to 10,890. You have paid 110 rupees in commission out of your 1,000 rupee profit. Now 110 rupees in commission in 1,000 rupee profit is 11%. You have given 11% of your profit to the AMC. So it is not just 1%, which is the expense ratio. Look at from this angle as well. It is extremely important to understand this part as well. Had the return been less, let's say just 5%, in that case, this percentage would have been even more. For example, in the first example, we took 10% return. Let's say the fund gave you a 5% return. In that case, the return would be just half, 990 rupees divided by 2, which is 445 rupees. Now how much money have you earned? 10,000 you invested, 445 is the return minus 100 rupees, which is the expense ratio. As I said, this is charged on the investment that you do, not on the return. So this is still 100 rupees. So now your money has grown to 10,345. The profit, had the expense ratio been 0, would have been 500. So now 345 profit could have been 500, which basically means they have charged 150 rupees in this commission. 150 out of 500. This is almost 30%. This is huge. So you should always look at the expense ratio. This will eat up a lot of money of yours in the long term. So please check the expense ratio. But now there's one more very important thing. Don't look at expense ratio in isolation. For example, if the return had been higher, 20% or 30%, even then the expense ratio was 1%. So even then you would have paid 100 rupees in commission. So in that case, the percentage the AMC has charged would have been way less. When you look at expense ratio and performance together. Now tell me something. If the portfolio manager is really skilled, he would take high salary, right? He would take really high salary. In that case, the expense ratio would go up. So it is okay. If the expense ratio is higher, I am looking at higher returns. It would make zero sense if the expense ratio is really high, but the return of the fund is less, right? So if the expense ratio is 2%, but the return is also like 30-35% of that mutual fund for like 5 years or 10 years, then it's okay, because the person is actually giving you more return, and in return he'll just taking 2% expense, and that's okay. It would make zero sense if it is just the opposite. The return is less but the expense ratio is high. I hope you understood this concept, because it is extremely important to understand. I really wanted to cover the remaining 3 parts of this framework in this video, but I think the video would get a bit too long. I will release a part 3 of this video. In that, I will talk about the remaining 3 parts of this framework. Along with that, I will show you live how to invest in a mutual fund. I'll also share you my recommendation, my favorite mutual fund where I invest a lot of money, and I will use both the platforms. I'll use Coin as well as Grow. So you're free to choose whichever you like. Until then, keep investing in your dreams.